Today's market moves weren't just about stocks finishing lower. They reflected a deeper shift in how investors are thinking about inflation, growth, and how much risk they're willing to carry when oil and bond yields rise at the same time. What we saw today was less about panic and more about markets quietly repricing fragility. The major indexes closed modestly lower. The S&P 500 fell around 0.4%. The Dow also declined, and the Nasdaq underperformed as technology and software names took the brunt of the selling. But the more important action happened beneath the surface. Oil surged sharply, driven by renewed tension around the Strait of Hormuz and concerns over shipping disruption. At the same time, the U.S. 10-year Treasury yield moved higher again. That combination matters. When oil rises, investors begin reassessing inflation risk. When yields rise, future earnings become worth less in today's dollars. Together, they create pressure on the parts of the market priced for optimism. And that's exactly where the damage showed up. Software and growth stocks weakened significantly. ServiceNow saw a sharp decline after earnings, and weakness spread across the broader tech complex. IBM, Tesla, Oracle, and other growth-linked names also struggled. This wasn't just about individual companies missing expectations. It was a sign that markets are becoming less forgiving. In a low-rate, high-liquidity environment, investors often reward long-term stories and future potential. In a higher-yield environment with geopolitical stress, they start demanding near-term certainty, stable margins, and dependable cash flow. That helps explain where money moved instead. Utilities, consumer staples, and industrials outperformed. These are the types of sectors investors rotate into when they want resilience over excitement. So today looked like institutional capital staying invested, but becoming more selective. That distinction is important. This was not broad liquidation. Volatility remained relatively contained. Bitcoin and gold were lower, but not collapsing. That suggests measured de-risking rather than full risk-off behavior. In other words, investors did not run from markets. They simply paid more attention to quality, pricing power, and earnings visibility. One open question investors are debating right now is whether this is just a temporary rotation or the early stage of a broader repricing in leadership away from tech and toward more defensive sectors. I'd be curious how you see that developing. Feel free to share your view in the comments. The hidden risk here is concentration. For months, much of the market's strength has relied heavily on AI enthusiasm and a relatively narrow group of growth leaders. When that leadership weakens while oil rises and yields climb, broader indexes can appear stable even as internal market conditions deteriorate. That's often how transitions begin, quietly. The bigger macro message from today is that markets may be shifting from a policy-driven narrative to an input cost narrative. For much of the past cycle, investors focused on the Fed, rate cuts, and soft landing hopes. Now the market may care more about energy prices, supply chains, margins, and whether higher yields remain sticky. That's a meaningful change in focus. Looking ahead, several catalysts could test this move. First, any new developments around Iran or the Strait of Hormuz could quickly impact oil prices and inflation expectations. Second, upcoming earnings reports now matter less for headline beats and more for forward confidence. Markets want reassurance that spending demand remains intact. And third, inflation data will be watched closely. If higher energy costs begin to feed into broader prices, bond yields could remain under pressure. What this suggests for investors is that today's market is not signaling crisis, but it is signaling discipline. Capital appears willing to stay in the market, but less willing to overpay for uncertainty. That often creates a tougher environment for speculative leadership and a better one for companies with durable cash flow and pricing power. If you enjoyed this type of calm, analytical breakdown of global markets, consider subscribing. I publish regular briefings focused on the deeper forces shaping market behavior. Thank you for spending a few minutes here today. I appreciate you being part of the channel.